Good morning, ladies and gentlemen. Welcome to the Phoenix results presentation. This is the first time I have done an annual results presentation since I took over as chair on the 1st of October last year, though, of course, I think many of you were here for our reterming presentation, which I also introduced. Let me just first briefly introduce our team. On the far end of the podium, on your right, Chris Samuel from Ignis, Mike Merrick, who runs the life companies, Jim McConville, our finance director, and the one-armed man, Clive Bannister. I should point out that Clive did not break his arm in a fight with any of our bankers. He fell off his bicycle when he was speeding. His wife took the points, of course, but he got the broken arm. Now, the key concern that our shareholders voiced when I joined the group last year was the need to reterm our bank debt, that was step one in any process which would deliver us a happier future, and we've achieved that. And in doing so, I think we have delivered longer-term stability for the group, which provides a platform for the next phase in our development. So I'm delighted to be here today to announce a strong set of results for 2012 and to say that we look forward now with confidence to the group's future. We're going to take you through the presentation now, and then we are all at your disposal to answer any questions you may have at the end. So without further ado, I'm going to hand you over to Clive Bannister. Clive.
Howard, thank you. The truth about my arm is, of course, far more sinister. It's the attitude a new chairman takes to people who don't show enough enthusiasm in the budgeting process. So we will move rapidly on. I add my welcome to his to hear about our 2012 results. As Howard has already highlighted, our most important achievement has been the debt reterming and equity raising, which we announced in January. To recap, we set out the key details here. The transaction comprised two equally important components. First, an equity raising of £250 million at 500 pence per share, and second, £450 million prepayment and a reterming of our Impala debt facility. At the EGM in February, 96% of our votes were cast in favour of the board's recommendation, and 93% of our shareholders took up their entitlements. The key outcomes of this transaction from a shareholder perspective were as follows. First, the extension of our debt maturity from an average of 34 months to 78 months, e.g. ending in June 2019, and the elimination of the bullet payments which had previously posed a refinancing challenge. Second, a significant reduction in mandatory amortization, which better aligns our debt repayments to our longer-term cash flow profile, thereby improving our resilience during periods of stress. And finally, a 27% increase in the recommended 2012 final dividend to 26.7 pence per share, and amended bank covenants which allow for further dividend increases. As the chairman said, 2012 has been an important and successful year for the Phoenix Group, both from a financial and operational point of view. We've delivered cash generation at the top end of our target range. We've reduced our gearing and adopted a new methodology which is consistent with the approach used by the world's leading rating agencies. Our group solvency position has been strengthened through management actions which increased the surplus and at the same time reduced our exposure to external market stresses. And we've achieved strong IFRS operating profits and maintained the embedded value in the business despite the book's runoff. All of these achievements have culminated in a proposed final dividend of 26.7 pence per share. We set ourselves targets against three financial metrics, and I am very pleased to report that we have met all of these targets in 2012. Our target range for cash generation for 2012 was £600 to £700 million, and it's good to report that we achieved cash generation of £690 million. In total, over the course of the last 2 years, we have achieved £1.5 billion of cash generation towards our 6-year target of £3.3 billion between 2011 and 2016. MCEV is the second key metric against which we measure our performance. By the end of 2012, we had delivered £332 million of additional value towards our £400 million cumulative target from 2011 to 2014. And on our old gearing methodology, we achieved gearing of 42% at the end of 2012 against a target of 43% or below. Later on, I will describe the targets we are setting for ourselves in 2013 and beyond. Operationally, we have made significant progress across the entire group. Here we set out some of the key operational achievements in 2012. I am particularly pleased with the progress we have made in simplifying the group structure, having gone from 7 UK life companies at the premium listing in July 2010 to just 3 UK life companies by the end of 2012. In June, we announced the transfer of £5 billion of annuity liabilities to Guardian Assurance, allowing the release of capital and the reduction by 1/3 of our sensitivity to longevity risk. During 2012, £1.6 billion of our customers' pension policies vested, and from this, we added £1 billion of annuities to our annuities portfolio. Our ability to write annuities in this way increases our annuities book and provides the opportunity to consider further annuity transfer transactions in the future. We transferred 780,000 in-force policies onto our new administration platform, and we now have over half of our 6 million policyholders on this efficient system. Our policyholders remain a key focus of our business, and through distribution of the inherited estate, we have been able to continue to improve our customer proposition. Ignis continues to make good progress in building its third-party business, with £1.6 billion of net third-party assets secured, excluding the annuity transfer transaction. And Ignis's most important criteria, investment performance, continues to improve, with 79% of assets outperforming their relevant benchmark or peer group compared to 73% in the prior year. Ignis has also completed the outsourcing of certain of its back-office functions to HSBC and restructured its joint venture arrangements, allowing the company to focus more on its own clients. Now I'd like to hand you to Jim to take you through more of our maths. Jim.
Thank you very much, Clive. Good morning, everyone. For the benefit of everyone, I've got 2 hands. Okay. We set out here our key numbers. Where relevant, we have shown the pro forma position to reflect the impact of the debt returning and equity raising which we announced in January. I will take you through each of the key metrics in more detail shortly, but in summary, cash generation was at the top end of our target range. IFRS operating profits were up 6% from last year. MCEV remained resilient and maintained at £2.1 billion despite the natural runoff of the book. Our IGD and PLHL ICA positions have been strengthened, gearing has reduced, and assets under management were down slightly at 70.2 billion after taking account of the remaining annuity transfer assets still to be received. And as Clive mentioned, we have announced a 27% increase in our final dividend. Free surplus represents the excess capital over and above the strong capital policies in the life companies, which is available for distribution to the holding companies.
I am very pleased to report free surplus generation during 2012 of £1.1 billion. By comparison, the 2011 position was adversely impacted by the effect of challenging market conditions. Contributing to the free surplus generation was strong operating profits. The annuity transaction, which generated £252 million of free surplus, and our London Life and Phoenix Life Assurance Funds merger, which completed in Q3 and generated £192 million of free surplus. Capital requirement runoff of approximately £200 million also contributed to the overall movement. Of the £1.1 billion of free surplus generated in 2012, we distributed £661 million, or 62%, to the holding companies in the form of cash to meet holding company outflows, including shareholder dividends. This left a closing free surplus in the life companies of £514 million, in addition to the £1.1 billion of cash in the holding companies. We generated £690 million of cash in 2012. Excluding management actions, the operating subsidiaries distributed £481 million of cash to the holding companies. Distributions from the operating companies are typically around £400 million per annum, but favourable market conditions, particularly narrowing credit spreads and rising equities, resulted in the 2012 distributions being higher. Operating expenses fell by 29% during 2012, reflecting the impact of cost management. The increase in pension costs is due to all contributions now being paid by the holding companies. Outflows in respect of debt interest, debt repayments and shareholder dividends in 2012 relate to the previous bank facility agreements. And we finished 2012 with over £1 billion of cash at the holding companies, and £239 million of this was used in February towards the £450 million debt repayment. We generated IFRS operating profits of £410 million in 2012, a 6% increase on 2011, driven by our focus on management actions such as modelling improvements and policy harmonisations, which enhanced the Phoenix Life operating profit by £117 million, and group costs, which reduced by £22 million compared to 2011. We continue to amortise the acquired in-force intangible, which was recognised at the time of the Liberty transaction in 2009, in line with the run-off of the book. And following the transfer of £5 billion of annuities to Guardian, recurring operating profits generated by Phoenix Life are expected to be in the region of £250 million per annum. Of course, this will trend down over time, but does not include any benefits which may arise from our ongoing programme of management actions. The annuity transaction resulted in a £177 million one-off gain under IFRS. The deal was priced on best estimate liabilities, whereas IFRS liabilities were valued on a more prudent basis, so we recognised a gain under IFRS. This was offset by other regulatory change and systems transformation costs totalling £28 million and restructuring costs of £19 million. And after finance costs and tax, we generated a profit of £409 million. Ignis generated profits of £43 million in 2012, a slight dip versus 2011 and 2010, reflecting the restructuring of joint ventures and the impact of outsourcing administrative services to HSBC, offset by growth in the third-party franchise. In addition, Ignis has invested in its fund management capability as it continues to grow its third-party business. Overall, expenses remain flat despite this investment. Since the end of 29, and taking into account the remaining 1.6 billion of assets relating to the annuity transaction, third-party assets as a proportion of total group assets under management has almost doubled to 19%. Having outsourced its back office functions to HSBC and restructured Ignis's joint venture arrangements so it can focus on its proprietary investment capabilities and own clients, Ignis is well placed to continue to grow its third-party franchise. After taking into account the remaining 1.6 billion of assets relating to the annuity transaction, group assets under management fell slightly by £1.9 billion, or 2.8% during 2012, to £70.2 billion. £4.7 billion of natural life company asset runoff was offset to a large extent by net third-party inflows of £1.6 billion, excluding the annuity transaction, and £2.7 billion of positive market movements. But the impact of joint venture restructuring and a net £0.4 billion reduction from the annuity transaction also contributed to this overall decrease. Now turning to look at MCEV. We set out here the material movements in MCEV over the year. We have stripped out the value generated from management actions, from operating earnings, and economic and non-operating variances to provide a more meaningful analysis. We closed 2012 with MCEV at £2.1 billion. The MCEV has remained stable at this level for the last 3 years, demonstrating our real strength in delivering incremental value through management actions, which we have used to offset the natural runoff of the closed book. So moving from left to right, we generated post-tax operating earnings of £203 million, which reflects expected returns on the £3.8 billion of life company value at the long-term risk-free rate of 2.58%. In 2012, we delivered management actions of £167 million through modelling and policy harmonisations within Phoenix Life and the annuity transaction. Below-the-line economic variances and non-recurring items totalled negative £45 million in 2012 and included the impact of the increase in market value of the Tier 1 bonds during the year and various project-related costs. We incurred finance costs of £123 million and dividends of £73 million. And the final impact we show here primarily relates to the change in the IFRS position of the Pearl Pension Scheme. During 2012, the Pearl Pension Scheme moved into an IAS 19 deficit, and this was included in the closing MCEV, reducing it by £0.1 billion. At the end of 2012, the MCEV of £2.1 billion represented MCEV per share of £12.15p. It is important to remember that the MCEV includes Ignis and the service companies at their net asset value of £0.2 billion. It does not include anything in respect of the value of future profits from these operating companies, which represents a significant source of additional value in the group. The debt returning and equity raising increases the 31st December position to £2.3 billion on a pro forma basis, representing MCEV per share of £10.39p, after taking into account the new shares issued during the equity raising. Moving on to group capital. As a reminder, we look at our group solvency position on two bases. The PLHL-ICA, which is an assessment on a Pillar 2 basis of the capital resources and requirements arising from the obligations and risks which exist outside the life companies. And the IGD, which is a Pillar 1 assessment of the group's capital resources and requirements and further details of the Group's capital management framework are set out in the appendix. Since 30th June 2012, we have significantly strengthened the PLH LICA position, increasing the surplus from £0.4 billion to £1 billion at the year-end. This was largely a result of the agreement with the Peril Pension Scheme trustees, which improved the surplus by £0.3 billion and reduced the sensitivity of the calculation to external market stresses, and capital generation of £0.4 billion, including the transfer of the business from London Life to Peril and positive market movements. The £450 million debt repayment made in February was partly funded by internal cash resources, and therefore the surplus is £0.2 billion lower at £0.8 billion on a pro forma basis. Our IGD position remains robust and continues to be relatively insensitive to market movements. The IGD surplus increased by £0.1 billion to £1.4 billion at the year-end. The impact of entering into the reinsurance arrangement for the annuity transaction was relatively limited from an IGD perspective during 2012. However, when the Part 7 transfer takes place later this year, we would expect a significant benefit on an IGD basis of at least £0.2 billion. As with the PLH LICA, the surplus would be £0.2 billion lower after the debt repayment made in February, bringing the surplus to £1.2 billion on a pro forma basis. And finally, turning to dividends. We have increased our final 2012 dividend by 27% compared to the 2011 final dividend, to 26.7p per share. This represents a total cost of the 2012 final dividend of £60 million. The previous dividend restrictions have now been removed, and we now have dividend capacity for 2013 of £125 million, and this capacity will increase by £10 million per annum. Future dividends are met by strong and predictable cash generation from the operating companies. You will hear from Clive that we have increased our cash generation target from 2011 to 2016 to £3.5 billion. And after the £1.5 billion we have already delivered, we have £2 billion to deliver over the next 4 years, giving average annual cash generation of £500 million. For reference, we have set out the sensitivity of the £3.5 million target to external market stresses in the appendix. So on this slide, we show the various uses of that cash at the holding companies. So moving from left to right. Annual operating expenses in the holding companies are around £40 million. And then there's £80 million of illustrative average annual pension contributions, reflecting £25 million of contributions into the PGL scheme, which was what we paid in 2012 under the existing funding plan. And on the Peril side, £70 million per annum in 2013 and 14, and £40 million per annum in 15 and 16 under the new funding plan. So an average of £55 million per annum. We have average debt interest costs of around £100 million on the revised facilities, including the Tier 1 coupon. And then the target debt repayments of £145 million, being £120 million per annum on Impala and £25 million on Peril, giving illustrative net cash available for additional debt repayments, dividends and reinvestment of £135 million. This is, of course, in addition to the £0.8 billion of cash at the holding companies post the Impala debt prepayment. As we said this time last year, including 2011 and 2012, £9 billion of cash is expected to emerge from the existing business inherent future profits and capital releases. We remain confident in the business's strong and predictable cash generation and in our ability to deliver value to shareholders. I'd now like to hand you over to Mike Merrick.
Thanks, Jim. Good morning, everyone. I'm very pleased to have the opportunity today to talk to you about the Phoenix Life operating model. We call this the Phoenix Way. The Phoenix Way is our solution to the challenge of increasing value and generating cash flow for shareholders and for policyholders. Our operating environment is a complex one. We have a myriad of reporting bases and methodologies that Jim's just taken you through, and a book of business with various systems. Alongside that, we have an ever-changing regulatory landscape, and throughout we need to maintain a flexible cost base. The Phoenix Way is our methodology for delivering value within this operating environment. The 4 boxes represent the categories in which we place all of our activity. Restructuring represents activities such as funds mergers. Operational management seeks to address legacy issues and standardise how we do things, such as dealing with and providing for outstanding claims. Outsourcing is all about simplifying our arrangements and helping to ensure our cost base reduces as the policies run off. And finally, risk management focuses on taking risk in the right places and ensuring we have standardised controls to reduce operational risk. We operate an efficient outsourced model and have converted almost 2/3 of our Phoenix Life cost base from fixed to variable costs through our outsource arrangements. The cost paid to outsourcers for core administrative services has reduced by approximately 9% per annum over the last 3 years, while our policies run off at around 8% per annum. The simple, scalable operating model which we've put in place helps to ensure costs run off in line with our policies and can be applied to other closed funds in the future. Our policyholders are central to everything that we do, and we are very focused on improving our customer proposition. We wrote £1 billion of new annuities from existing policyholders in 2012. Typically, 99% of policyholders with guaranteed annuity rates choose to take those rates up. And in 2012, we also retained almost 75% of those policies that don't have these guarantees. The remaining 25% took their open market option. We will continue to write annuity business where it makes sense for customers and continues to be profitable. Moving on to the inherited estate. Some of our healthy with-profit funds have more assets than they need to cover their liabilities to policyholders. We call this the estate. During 2012, we distributed £109 million of the estate, of which £10 million was distributed to the shareholder fund. At the end of the year, the estates in our with-profit funds were worth £2.3 billion, so there remains a significant opportunity to increase policy payouts in future, benefiting both policyholders and shareholders. We have real strength and expertise in managing closed life funds. As Jim has already mentioned, we have generated £332 million of incremental value over the last 2 years. And over the last 3 years, we've also accelerated £0.8 billion of cash to the holding companies, which would have emerged from the business over a much longer period. During 2012, improved actuarial modelling as the result of our actuarial systems transformation programme released £60 million of capital, and we were also able to release £22 million of capital held against operational risk. The management of our equity exposure and reduction of other market risks released £43 million of capital, and £29 million of capital release was accelerated through the harmonisation of accounting policies across the book. Since we now have 3 UK life companies, there is less intercompany restructuring to do. But the aim remains to simplify the structure further to leave just 1 UK life company. And within these 3 life companies, there still remain many funds, and opportunities exist to undertake restructuring between those funds, which will add value and accelerate cash. Other areas of management action focus include further annuity transfers, further data cleansing, which will accelerate capital release, and further risk management as we rationalise and harmonise asset liability management practices across the group. We remain convinced that there is still a significant opportunity to generate value and accelerate cash from this business for the benefit of both policyholders and shareholders. And with that, I'd like to hand you back to Clive. Clive.
Mike, thank you very much. So I turn again to this familiar slide, which sets out how we see the Phoenix Group journey continuing. This time last year, I stood here and talked about how reterming our bank debt was our #1 priority. This has now been achieved, and through the new terms, we have been able to align our debt repayments more closely to our longer-term cash flows. We have now put in place a capital structure for the long term that removes uncertainty and allows us to focus on the next stage of the journey as the UK's leading and largest consolidator of closed life funds. In addition to the very many organic opportunities that Mike has just described, key to the next phase of the group's journey are external opportunities for growth. We estimate that there are over £200 billion of assets sitting in closed or quasi-closed life funds in the UK. These assets are owned by banks, other UK life companies and other foreign-owned life companies based in the UK, which are either formally closed to new business or write so little new business in actuality that they are effectively closed. As the regulatory environment evolves, these assets will become increasingly costly to administer for their current owners, are inherently capital intensive, and are likely to come under increasing regulatory scrutiny to ensure that policyholders are treated fairly. Having delivered long-term capital stability through the debt reterming and equity raising, we now have a capital position and an operating platform which is scalable. We are well positioned to take advantage of the opportunities for consolidation in this industry. It goes without saying that we would only do deals if they are good for all of our stakeholders and deliver reduced gearing to maintain the group's financial stability and its target of 40% gearing by 2016. We have a strong and predictable business which provides the confidence to set long-term targets for cash generation in addition to our shorter annual cash generation target. We have achieved or exceeded our annual cash generation target for the last 3 years, and our ability to undertake management actions, as Mike has shown, to accelerate cash and increase value has allowed us to increase this long-term cash generation twice in the last 12 months. This time last year, we had a long-term cash generation target of £3.2 billion. At the time of our interim results, we increased it by £100 million, and I am delighted to announce a further increase of £200 million to £3.5 billion, demonstrating this business's real strength in cash generation. I'm very pleased that we achieved all of our financial targets in 2012, and today we set new targets for 2013 and beyond. In addition to the long-term cash generation target I have just mentioned, we set an annual cash generation target for 2013 of between £650 and £750 million of cash flow. Having already delivered £332 million of incremental embedded value in 2011 and 2012, we reiterate our MCEV management actions target of delivering £400 million of incremental embedded value by 2014. Finally, we have adopted a revised and more industry-consistent gearing methodology. At the end of 2012, and after taking account of the debt repayment made in February, our gearing was 48%. We set a new target to reduce our gearing to 40% or below by the end of 2016. To conclude, we have delivered a strong set of results of which we are proud, which demonstrate the resilience of the Phoenix Group. In 2012, we generated £1.1 billion of free surplus and a further £690 million of cash. We delivered £410 million of IFRS operating profits, and in the last 2 years, we have generated £332 million of incremental MCEV value through management actions. We remain convinced of the inherent value of this business and have a clear strategy to deliver that value to all of our shareholders. Our focus in 2013 and beyond is, first, to ensure we achieve the financial targets we have set ourselves in respect of cash generation, incremental MCEV, and reduced gearing. Second, to continue to build on building both on our operational achievements in Phoenix Life and in Ignis. And finally, to pursue opportunities for growth through the consolidation of closed life funds in the UK. This brings me to the end of the formal presentation, and I will hand you over to our chairman.
Thanks very much, Clive, Jim, Mike. We're now happy to take your questions. We'll take them in the hall first and maybe have some that appear over the airwaves. But if you could wait for a microphone and then give your name. Whoa, gosh. First, second row here. I think you just about got in. Thanks.
Thanks. It's Kevin Ryan from Investec. Just a couple of questions, please. Could you give us a feel for the timing of getting 3 life companies into one, and also what sort of benefits we might expect to emerge from that? And second, how hot to trot are you in terms of looking for non-organic growth, and what sort of size of fund are you looking at? Or does that depend on the cash that might be extractable from it?
Thanks. Mike, do you want to deal with the first one and then Clive the second?
Yeah, so getting the 3 life companies into one, I think that is a cross-silo fund merger, and therefore needs there to be effectively one banking silo. So it will follow any change to the silo arrangements, and I think we've said that it'll generate capital synergies in the mid-tens of millions.
So I think in terms of timing, if you thought of the repayment of the Pearl debt in 2016, that would be a time when we could contemplate putting the two main companies together.
Clive.
Kevin, thank you for your question. Hot to trot, there's an interesting way of describing it. This group's success for its shareholders is not predicated on doing any deals. The success of this organisation for its shareholders is doing more and better with what we have got, and we deliberately asked Mike to go through in great detail the management actions that have been achieved to date and the more management actions that stand in front of us. And in that respect, shareholder value, by announcing 650 to 750 cash flow, increasing our 2016 target to 3.5 billion, is to allay anybody's concerns that we have to do deals to make this business economically successful for our shareholders. I would say that we do think that there are opportunities. I went through the size of the market at 200 billion. We think there is going to be a change. Things in the life business, as we know, evolve slowly. So the tectonic plates are moving in the sense that there are businesses that are either close or closing. They live in homes, let's say a foreign insurer. a bank in the UK where it becomes more costly to administer, there's a capital cost attached, and there will be ever-increasing scrutiny on how policyholders are treated. So we think that with the way the markets have moved, that there is the opportunity for deals to emerge. I don't think it's like a set of red London buses, and there are going to be a whole slew of them. As you know, there was only one deal done since then, and there's been a period of quiet. And I think a lot of that was associated with Solvency II. Vendors did not know what they were selling, and acquirers did not know what they were really going to buy. But with the evolving ICA Plus regime, I think it makes it easier for both sides. I would hasten to add that we are very clear that we would only do a transaction which was enhancing to our shareholder, delivering value to them, and we are categorically committed to de-gearing this business. And we've given the target to be 40% or better by 2016. So any deal that we would contemplate would have to be done fulfilling those two criteria, and that is very important for all of our shareholders. So I end with where I began. We do not need to be dependent upon doing deals to deliver shareholders value, and we are enormously committed to doing more and better with what we've got.
Third, yeah, there. Thanks. No,
Thank you. Ben Cohen at Canaccord. I had two questions, please. Firstly, on Ignis, I was just wondering if you could say something as to how you see the operating performance going forward. I don't know whether you saw the 2012 result as maybe a little bit disappointing, but maybe you could just say more in terms of how you're going to take that business going forward. And the second thing I wanted to ask was on slide 25, you had a discussion of the inherited estate distribution. Could you just remind us in terms of the levers that you have there to increase the payouts to policyholders and then to shareholders? Thank you.
Thanks. Chris, do you want to do the first one and then...
Yeah, Ben, thank you. I suppose two things. First of all, we certainly don't see Ignis's results as disappointing. Just to sort of give you the overview, we reported 46 last year. There are some quite sort of big changes to the business model. We've ceased to provide administration services to the life company on the back of the outsourcing, and also restructured the JVs, which means that we're foregoing a revenue share now in return for a capital gain, we hope, in the future. So that's quite a significant restructuring of the business. Against that, of course, you've got the life company assets running off. And we feel that we've done well to win third-party business that has brought us, if you like, back from that adjusted number back up to 43. I think it's worth saying what we've said in the past as well, which is that we have a significant element of performance fees in here, which are a tad down from last year, but there will always be that variability. In terms of going forward, it's business as usual for us. I think we've set out our stall very clearly, that what we want to do is to have a broad business and to develop each of those. And I think we've said publicly, certainly I've said publicly, that we're extremely pleased with how our fixed income business, our multi-manager business, our real estate businesses are going. We feel we've got a bit more work to do on the equity side, so we will be focusing on pushing that forward.
Thank you. Inherited estate, Mike?
So in terms of the heritage estate, if I can refer you back to slide 25, where the picture there of on the right-hand side of the broad balance sheet of a with-profit fund. So the totality is the assets, and the assets back either liabilities, the ICA or the estate. The more we can convert, the bigger we can get that excess estate figure, then we can therefore release that extra capital confidently to policyholders. So it's either by directly increasing the estate through the similar kinds of management actions that we talk about in the shareholder world. We're doing the same kinds of things for policyholders, but also risk reduction. So if we can actually reduce risk for policyholders through better asset liability management or risk transfer, then the ICA will come down, and if the ICA comes down, the excess assets goes up, and you distribute more to policyholders. So it's a very similar picture to what we go through in terms of releasing capital for shareholders.
Thanks. Yeah, and immediately behind, and then you, and then you. Thanks.
John Hocking from Morgan Stanley. I've got two questions, please. Slide 45, where you give the maturity profile of cash flows. You can see the impact of management actions in terms of accelerating those cash flows. How do you think of the dividend policy in the light of that chart? Because you're growing the dividend, and obviously the cash flows in the medium term are that much lower than they would have been had you not put through the management actions. That's the first question. The second question, on the annuity transfers, given that you're looking at external opportunities, what is the judgment call between actually retaining those annuities and using that as part of the sort of growth strategy, as it were, rather than actually looking at inorganic opportunities? Thank you.
Thanks. Jim on the first, perhaps, and then Clive.
Yes, thank you. So, I mean, as you quite rightly observed, John, clearly our cash profile of the business and MCV generation has been enhanced by management actions. And you see the maturity profile of the business from the MCV of going out in outer years. Now, that analysis will not have within it the management actions that could be delivered in the outer years, because by definition we haven't got to that point where we identify them. We have a continual programme for looking at management actions. It's regularly refreshed and monitored on a very regular basis, and typically looks forward 2 or 3 years. And as we keep going, we see further opportunities arise that will hopefully benefit future cash flows and capital releases.
On the annuity point, Clive.
John, thank you for your question, and it was shown on slide 25. Last year, the annuities out of 1.6 billion being written, invested and retained for us was £1 billion. We're proud of that number. It makes us a top 5 player, and this is profitable business for our shareholders. Mike also alluded to the fact that in the range of management actions we can consider, we clearly have future opportunities, as we did the transfer last year in June, so that those type of transactions can be conceived. And we will do that in terms of thinking through the priorities to release cash, accelerate cash. That is one of our options. You then link that, John, to a question about which is preferential, to retain it for the reasons that make sense, or to accelerate further releases is to be able to better finance or pursue non-organic growth, i.e. do transactions. That's a sort of counterfactual. It's a what if. And I think with any transaction, you would ask, or the board would ask itself 4 questions. What is the size of the transaction? What is the quantity of synergies that could be generated? What is the time frame over it to be completed? One next Wednesday or in 4 years' time, because of our balance sheet position and where we would be. And then also in any financing, what financing structure would be dependent on the quantity of equity or quantity of debt, which would depend in part of the nature of the balance sheet of that which we might acquire. And so I can't answer your second question other than say that you've got multiple variables which would have to be considered at the time of the transaction. But I go back to saying that our primary role is to do more and better with what we've got. This company's success is not deal dependent, and any deal has to add value to shareholders and at the same time de-gear this business. And why we are monomanic on getting to 40% or better is because we are determined to get to an investment grade so that we have access to the subordinate market. That's in all of our stakeholders' interest, and to be able to refinance in an appropriate way our senior debt.
Good. Next question just there. Yep. Thank you.
James.
Morning. James Pearce from UBS. I imagine you've got a pretty good line into what the PRA and the FSA are thinking. What do they think about you doing M&A? I can see why it's good for getting your gearing down, but for the target companies, policyholders, they'd be exposed to a very geared capital structure. What implications does that have for the funding?
For the target,
for the acquired company's policyholder base, it exposes them to a much more geared owner, presumably. What are they thinking about the funding that you would need to put in place? Is it purely equity, or could you fund it in other ways? Secondly, something strange seems to have happened to your MCEV basis costs in the second half of the year, which I reckon were positive. Can you just elaborate on what happened there? I think you did 29 of costs in the first half, of head office operating costs, and it was 25 in the full year. So what was behind that?
Jim, do you want to deal with that second point
I'll deal with that
first,
second
and then
point
Clive will do.
in a second, once I get to my notes. This is what we have for MCV costs in 2012 was 25 million, and in 2011, 54 million. So you see the fall in costs for two main reasons. First was a fall in group costs of £10 million, which related to really cost management activity. We continually seek to drive down costs, and that is a pressure that we will be under forever. So I'm very keen that we continue on that journey. And secondly, in 2011, there was a net interest charge included within that figure because the Pearl pension scheme was in deficit, and that amounted to £14 million, but that was not repeated in 2012. I think part of the reason, James, you're looking at the half-year results and going forward, you will also note in the detailed commentary in the accounts that we've restated 23 million of costs from the previous year from operating earnings to OCI. So again, these are related to pension schemes, and we've adopted a treatment which is consistent with others in showing those costs within the OCI element of the statement, but it's only a line switch and there's no impact on the total MCV. And I think that's maybe why you're looking at the numbers quite oddly.
James, it's not my job to speak for the FSA, but let's take the observations you've made. A priori, you've said, is it a good idea to take policyholders out of a less leveraged business and put them, is it in their interest to put them in a more leveraged business? I don't think that stacks on. In any part, so the FSA would be party to any transaction because there would be a change in control requirement. And as you know, in Part 7s, you have to have expert advice ensuring that policyholders are not diminished, and that's on both sides of the fence. We are completely committed to doing the deleveraging. If we look at the maths, if you go back to 2009, on the new gearing methodology, we had a leverage level of 63%. At the closing of last year, having done the refinancing, it had gone down to 48%. So that's a 15% decline in our gearing in 3 years. And therefore, we're going from, and we have the ambition of going down from 48 to 40%, and we have 4 years to do that. So one of the asks for our investors is for them to rely on us to achieve that. We don't need to do deals. We're going to do more and better with what we've got. And that is how I would answer your question.
Here, row 3, and then there.
Hello, hi, it's Andy Hughes from Exxon BNP Paribas. I've got 3 questions if I could. The first one is about the plus bit. Obviously you mentioned the regime. The first bit is about the plus bit. So the first bit you mentioned was you're on an ICA plus basis. All the disclosure we've got here is on the ICA. Particularly I'm thinking about the group pension scheme because, you know, I can see quite a big ICA surplus at the holding company on an ICA basis, but I'm a bit worried that on an ICG basis it would look very different because you'd include the funding deficit, the pension scheme, which is about 500 million. The second thing is on, I guess, coming back on James' question about the new regulator, but my concern's somewhat different. Over the past, the group have quite successfully took management actions and merged Pillar 1 and Pillar 2 firms together to release capital from these businesses, yet the agreed basis of capitalisation is unchanged. Presumably you're still holding 125% of your ICA, and yet the new regulator is probably going to step up and re-look at the capital management plans for what is a business which has substantially lower ICA, but presumably a large degree of the same risks. Is there a danger they're going to come back and say, well, you need to hold much higher capital because the business has changed substantially over the last 5 years? And the final bit was on Mike's presentation on the annuities. I think he said that 99% of the GARs are the guaranteed annuity rate policies are staying internally. Presumably that's net of the 25% tax-free cash. And is that changed at all given interest rates are very low? And what's the sensitivity to that? Thank you.
Mike, could you deal with the last one, and then Jim, I think, the other 2.
Yeah, so it is. So 99% is after 25% more or less has gone out in cash, and that we do in our in the kind of stress scenarios we look at. We assume that 25% actually declines as interest rates fall, but actually policyholder behaviour doesn't actually change very much. People do tend to take the cash.
Jim, the point about ICA Plus.
Yeah, so ICA Plus, I mean, the ICA Plus regime obviously is new. We've obviously just introduced the ICA last year, so the discussions we've had with the FSA on how the PLHL ICA works are fairly recent. So we're not anticipating in the ICA Plus regime changes in terms of the mechanics of that calculation. And on your second question, clearly we are very aware of the Pillar 1 and Pillar 2 requirements, and we monitor both on a very careful basis. Again, Mike may want to comment further, but in thinking of our management actions, we do consider both bases, and we don't see any worsening of opportunity there as we go forward.
I think you also asked about the capital policy and whether that might change. I think you put it as having 125% of ICA capital policy. It's actually nearer 140%. So, and I think that puts us towards the upper end of the range of capital policy. So I think we're less at risk of that.
Yes. Third row here. Yeah. So I thought you, Oliver.
Oliver Steele at Deutsche Bank. Couple of questions. The first is about the £3.5 billion target. So if I take the midpoint of your target for 2013, you've got a bit over £430 million of gross cash flow built into your target per annum for 2014, 15 and 16. You made 481 million clean in 2012. Is that 433 your estimate of what the average underlying cash flow should be of the business? Because that sounds quite low for those 3 years. Or are you being conservative? And then the second question I've got is, I mean, you've tended to beat your underlying cash flow projections by a good 200, even 300 million a year per annum over the last 4 years, or 3 years, can't remember which. You seem to be targeting the same sort of beat in 2013. Hypothetically, if you like, how does the chairman view the choices between paying down debt faster and increasing the dividend capacity versus organically funded acquisitions? And I'm sorry, I've got one more question, which is you said that the benefit from the equity raise was 211 million net. That sounds quite a low figure compared to the 250, so I'm just wondering what went into that calculation.
Well, let me do with my question first. I think that the board has debated this at some length, and our view is very clear that the targets and priorities that have been set out today are the ones we support. We believe that we have to get the gearing down, as we explained in the reterming and in this presentation. In fact, the language is the same. And that is the number one priority for the group at this point. Once you get to that point, you begin to have some more flexibility, and at that point we can look at it again in the light of opportunities that are available to us. But I wouldn't want to prejudge how we would go beyond that point.
Right. Now I deal with the first question, and I'm going to turn to that slide there, which comes from Mike. Cash generation. How do we do the maths, and are we erring on the side of caution? Well, you'll see on the top left-hand side, 3 years ago it was 734 million, then it was 810, last year 690, and we're forecasting for this year a number between 650 and 750 million. On the left-hand side, you'll see the organic cash flows. That would be the winding down and the runoff, the natural runoff, and above that, in the blue, you see the management actions. This is a business where the horizon over which we choose to forecast and the quantities we forecast for management actions has to be thought about very carefully. We want the market to be very clear about what we genuinely believe and see and can do in the immediate 365 days. And then we have given a longer-term target to give people confidence about what is possible, coterminous with our debt repayments, substantial debt repayments of the returning of our debt in 2016. And as Jim said when he was speaking, we expect cash in total of circa 9 billion to emerge over time, and that's a longer time period to the maturity of our policies. To date, we've taken 1.5 billion out of that 9 billion. So what's going to happen this year? And the maths that you did, Oliver, was, and here I would go back to 21, he said 21, is that 500 million was, of course, the division. We've put out a target of 3.5 billion. We paid down 1.5 billion. You've got 2 billion left in 4 years, and you divide it by 4 and you get the 500 million. If we do, your math suggests circa 700 million in cash flow, that would mean in the remaining 3 years 433. I can't fault your maths, but I'm going to go back to orthodoxy, and I'll sound like a broken record, that we err on the side of caution because we would far prefer to underpromise and overdeliver, and that is what we have achieved to date. But there are many variables. To remind you of last year, we achieved no cash flow virtually in the first half of the year, and it all happened in the second half. So we have to give you counsel both about quantity and also timing, and there's a lumpiness to our business, depending on Part 7s and things beyond our control, judicial processes. But what we want to communicate is the sustainability of the cash flow in 1 year, over until 2016, and in the context of our overall book.
There's one more here. Yeah. Sorry, there was a phone. Sorry.
The final question that you asked Oliver, which was on the fees related to the equity transaction, which included the 250 million equity raising and the net 211. I think the thing to remember, it was both an equity raising and a debt reterming. So that difference does include the bank consent fees, which were approximately £21 million, and then there was a spread of £18 million related to both the professional fees and underwriting fees for both the equity transaction and the bank reterming. So you have to look at it in the context of a £2 billion bank reterming and a £250 million capital raising.
Yeah.
Hi, it's Colin Simpson from Goldman Sachs. Could you give us a sense of the quantum of capital that might be sitting in with-profits funds backing non-profit business that could be released if you were to move that non-profit business out of the with-profit funds? And the second question is maybe somewhat theoretical, but I noticed that your MCV growth metric has the same value as cash flow in management remuneration. And one of the easiest ways to improve MCV might be through annuity transfers. But the market's almost telling you that the MCV of an annuity book is not its true market value because the market's willing to pay more than that. I just wonder, maybe a bit of colour on why MCV is so important to the group.
The first one, do you want to deal with that, Mike, and then Clive on the second one? Or?
So the question was, is there capital tied up in the with-profit fund that could be released by transferring non-profit business out of the with-profit fund? There is. I can't tell you the quantum, but in any event, it would fall to policyholders and not to shareholders. So it's mainly, going back to the point earlier, it would enable estate distribution to happen. I mean, there is shareholder capital backing some of the with-profit funds, and that is something that we seek to try and reduce, and is part of the management actions that we look at. But that wouldn't necessarily be directly affected by transferring non-profit business out. So,
if I may, I'll give the untechnical answer, and I'm going to look for Jim to give us the technical answer. Positioning the firm 3 years ago, there was a challenge as to whether a run-off fund just inexorably runs off, and the DCF models that many analysts use needed to see if that rate was accelerating or could be arrested. So it was very important for us to put clear metrics in the public domain that people could track and then believe in, and as we reliably delivered. And they were cash flow, MCV enhancement, and de-gearing. So the MC enhancement, if we were to do nothing, there would be a capital unwind of circa 5 to 8% per annum. So it was important to show that we could do not just capital acceleration, cash flow acceleration, but we could add real value through restructurings, as have been mentioned today, tax enhancement, etc. And therefore we gave ourselves the target of 400 million incremental MCV between 11 and 14. We're proud that we are more than two-thirds, 75% ahead of that, and that gives us confidence that we can add value by actively managing the assets that we have. So that's my non-technical answer. I'm sure there's a better technical answer, which is going to come from Jim.
Yeah, well, I think the important thing to remember is we've got a range of different measures. MCV is a value measure, and in relation to the annuity transactions that you alluded to, if you think what happened in 2012, the annuity transaction resulted in a small incremental benefit to MCV, so it was value enhancing, but it delivered a very significant increase in the ICA surplus, which will turn itself into cash. So there was a disconnect between the size of the cash benefit versus the size of the value generation on an MCV basis. So different activities do have different impacts across the different measures. And I think what we're trying to get is that basket of measures within the remuneration structure.
Thank you. I think that's... Oh, no, it's another one, yeah. Thanks. Pink shirt, blue tie. Thanks.
Hello, Alan Devlin from Barclays. Just a question on page 37 on your sensitivity to the cash flows. First of all, you say a movement of 75 basis points increase in interest rates has basically no impact on the 3.5 billion of cash. I was just wondering why is that the case, and what actually does that 3.5 billion assume? Does that assume interest rates stay at this level for the next 4 or 5 years? And then secondly, on the impact of the 20% fall in the equity markets, is the reverse true? If markets increase by 20%, does that add 100 million to your cash flow targets?
Jim.
Okay, thank you for that one, Alan. I do love you. So what these cash sensitivities show is the base case is obviously the cash generation over the period 2011 to 2016, but clearly we're part of the way through that period, so the sensitivity movement is applied from 31st December 2012 through to 16. So that's how you get a relatively small impact in terms of the measures. In terms of, I think your second part of your question was, would a 20% increase in equity markets improve the position by roughly an equivalent amount? The life companies are broadly hedged in terms of equities, and so there would be a small uptick in terms of a 20% increase, but it wouldn't be a huge number.
Okay, do we have any questions that have appeared from anywhere else? No, we don't. So speak now or forever, well, until the half year, hold your peace. Okay, thank you very much to the team. Thank you for some interesting questions, and particularly thanks for coming.